You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to the Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on the Investor Way, we have Greggs, AG Barr, Tesco's, JD Sports, Tui, and PepsiCo. Sam, shall I kick us off with Greggs?
Absolutely. First of all, though, it's probably worth mentioning before we forget, it is our 200th episode this week.
Oh, gosh, it has flown by.
Not that we've planned anything for it, it's just going to be a regular episode, but I just thought it was worth mentioning because if I
Yeah.
didn't do it now, we'd definitely forget.
Yeah, no, absolutely. Well, quite a milestone, I think.
Should we dive into Greg's then?
So, Greggs, they had a Q3 trading statement out with the group reporting a 10.6% rise in sales over the third quarter, up 12.7% year to date. Like-for-like sales were up 5%, with September being the strongest month in the quarter. Performance continues to be driven by menu changes, extended opening hours, and the digital channels. The total store estate totaled 2,559 stores on the 28th of September 2024, with 140 to 160 net shop openings expected over the year. Cost inflation is now expected to be toward the lower end of the 4 to 5% guided range, and there was no other change to guidance. And the shares were down about 2.2% in early trading. In terms of valuation, Greggs has a market cap of 2.85 billion and trades at 21.6 times forward earnings, compared with a 10-year average of 23, and it has a prospective dividend yield of 2.3%. I thought these results were actually pretty decent. I think that they have been putting up the numbers. The comparatives aren't easy. It's always difficult though, and I think when it has a fairly toppy valuation, even when the numbers are, potentially slightly below what the market's expecting, there can be some disappointment with the shares. We've debated it before because I think Greggs is safe to say is a company that we both like. It has really come down to the valuation and potentially how saturated the UK market is with Greggs. And that's particularly the case in the north of England, though we have discussed, well, how much can it or how much expansion is left in the south. They are planning to get to 3,000 shops over the next few years. And I suppose they're reducing some of the risks slightly because they're increasing the number of the franchised shops to around 20%. And they're planning, I suppose this might answer some of our questions where that future growth comes from. They are planning on targeting train stations and airports more, which certainly has worked for some groups like, for example, WH Smith's quite well. I don't know. I think we've both said that we liked it a lot a few years ago and we sort of wished we'd bought shares there. It's not the sort of company that you really imagine going abroad and doing well there. I certainly can't see the French liking, a Greggs coming across the channel. So it is tricky. I think regardless of that price at the moment, I think saturation point is too much of an issue, I think, for me to be buying shares at right now. I think that's where I would probably be sitting with it, and that would be my judgment now. Sam, what are your thoughts?
Pretty similar. So I remember when we first started covering it, I didn't think they could get to 3,000 stores. I thought they were already pretty saturated at around 2,000. They're now at 2,559 and with 150 average shop openings expected in the year. So they're only 2 or 3 years away from it now, actually. It looks like they're going to do it. So I was wrong on that. However, and as well, it's still under half of the stores that are open until 7 or later. So they still have some levers to pull there. I think the issue is, although I was wrong in terms of the saturation a few years ago and the potential growth, the price hasn't really changed. So it's still quite expensive. I think if anything, it's actually more expensive. So it's at a forward PE of just under 22. But you kind of look at it and think, well, once they get to 3,000 stores, then what? Like, I know you talked about airports and stuff like that, but I don't know. I remember covering it when it was like 2,000 stores and it was at like 18 times earnings and thinking it was quite pricey then. So at 21, when they're at 2.5, I think I was wrong on it, and it is a great business, and we definitely underestimated how resilient it was in the pandemic. I think like airports and train stations probably is a logical next move, but I still don't know if I'd be comfortable buying it at 21 times earnings when it's already this far into the plan to get to 3,000 stores. Because I think those 3,000 stores are now priced in. Because what would happen if it increased the store count by another 20%? Assuming the earnings increase by a similar amount, it's like that PE might come down to about 15,
Yeah.
which probably pretty reasonable. But I think basically the current expansion plan is now fully priced in. So you need to really be a big believer in the train stations and airports idea. And I just don't know if I am. Maybe we'll be in the same position in a few years' time, saying, oh,
Yeah.
well, it was obvious, it's worked really well and we should have bought it then. But I don't feel as comfortable as I would have done a few years ago. And obviously I wasn't very comfortable with it then. So yeah.
No, fair enough. On to our next company then, a favourite of the show, AG Barr.
Yeah, well, it is a favorite of the show, but it's had to prove us wrong first, hasn't it? Because this was another one that we weren't massively keen on. We did historically prefer Britvic. However, AG Bar, they've got quite a few brands. So they have Funkin' Cocktails, Iron Brew, Rubicon. Those are probably the main ones. I might have forgotten something. They've got Boost as well. So they have come out with their half year results. And I'll start with a few extracts from the new CEO. I think it's Ewan Sutherland. I'm not 100% sure how you pronounce it, but Mr. Sutherland's statement: the business delivered both revenue and profit growth, as well as good progress on our key strategic margin rebuild program. We continue to invest in our supply chain to build the capacity to support our growth plans and manufacture more volume in-house. We anticipate a strong second half performance from our 4 core brands: Iron Brew, Rubicon, Boost, and Funkin'. In the business performance, overall revenue was 5.2% for the half, and that was driven mainly by soft drinks performance, with soft drinks up 7%, cocktail solutions, which is Funkin', down 9.4%, and other, which is mainly Moma, the oat milk drink, I think, up 7.7%. So they've said 7% growth in soft drink revenues was led by Rubicon, which continued to grow ahead of the market through distribution gains and on increases in marketing investment. Funkin' experienced a challenging first half with revenue down 9.4%. The key driver of this decline was ongoing weak consumer demand and in the on-trade channel, where late night venues remained particularly affected. More positively, the Funkin' ready-to-drink business has continued to grow at pace in the strategic growth channel of retail, despite revenue in the first half being impacted by a short-term issue with third-party can production, which impacted sales to retailers but is now resolved. Moma maintained its growth, which was at 7.7%, with new distribution gains. We expect Moma's growth to accelerate in the second half through further range development. Yeah, in terms of the actual figures, volumes were up 3.2%. Gross margin percentage was up 2.6% to 40.3%. Operating margin percentage was up 0.5% to 13%. Profit before tax was up 8.5% to 29.3%. Dividend per share was up 17% to 3.1p. And earnings per share was up 9.4% to 19.86p a share. Net cash in the bank was down 7.6% to 43.7 million, and the cash capital expenditure was up 13.8% to 7.4%. Oh yeah, so I think that's interesting because volumes are up, revenue's up more than volume, so they've been able to increase prices as well, and the margins are better, so they've not had to increase across the cost proportionally. So I think by any measure, it's an excellent half. And for 24-25 full year outlook, they've guided for mid-single digit revenue growth and approximately 13% margins. And they've said the margin rebuild program is on track to hit 14 to 15% in the 25-26 year. In terms of the valuation, the business trades at a P of about 18. What we would normally do at this point is compare it to Britvic, but Britvic has received a takeover offer, so that its PE is no longer that useful, with Britvic soon to come off the market once it's taken over by Carlsberg. So PE of 18. It's difficult because you could have got it a lot cheaper a few years ago. It definitely wasn't as popular, but it wasn't putting up the same kind of results. I think it was more around, I've got a figure in my head of around 14, but Yeah, P of 18. I don't think it's outrageous given the numbers it's putting up. And with a little bit of consistency now as well. This is the second half where we've seen at least the second half, might be the third or fourth actually, but we've seen a good few halves like this with these kind of figures. So it's putting up the figures. I think it has some exciting brands. It's not got the best brands, but I think Iron Brew, Rubicon, Funkin and MoMA, it's a pretty strong. The four core brands are quite strong, I do think, and I think there probably is quite a lot of growth opportunity. I think really it's one where we probably should have taken it a bit more seriously a couple of years ago. I don't know if, although I think the results are excellent and it can't help the price it trades at, but it's had a bit of a revaluation. And at 18 times earnings, I just don't know if it's going to grow mid-single digits. Yes, the margins are maybe going to go up another 1 or 2%, but you're paying 18 times earnings for basically mid-single digit growth. And if you're going to do that, why not get a Unilever or something else, which I would say has better brands? I guess you've got the argument that AG Barr, now that they're starting to perform well, they have a lot more room for growth because their market cap's only 700 million. But I think for me to buy at 18 times earnings, I think I would need to see a bit more from them. But that being said, I think it's an excellent half for the business and it can't help the valuation it trades at. About you, John?
Yeah, very similar. I think what it's done with its existing brands. So I remember or early on when we first started covering it, we were talking a lot about them losing Rockstar. But then actually, when you see what it's done with its Iron Brew brand and it's launching an energy drink range with that, it's done a lot there. And that's pretty impressive. Management have done a great job. Ewan Sutherland, I guess we'll wait and see, where he goes, because I know the previous chief executive had been there for 20 years, so he'd really overseen a lot of this. And it did prove us wrong on many fronts. I think Funkin, I know it's slight wobble on the on trade, but that's fantastic acquisition and also very strong brands in Rubicon. So yeah, I think it is a good company. I agree with you about the price, or the valuation, I should say, and then what else you could be considering with potentially much, much stronger brand portfolios. So I probably wouldn't. And again, it feels similar to Greg's missed the boat a little bit there. Although I think if it were, and I'm not spoiling the end of the show, but I think if it were between just Greg's and AG Barr, I would be going with AG Barr because, as you say, I think those brands it could get much bigger. Albeit that's certainly not guaranteed. Whereas I feel like Greg's that is very, very close to reaching saturation point, which is absolutely not the case for AG Barr.
Should we move on to another favourite of the show then?
Yes. So Tesco's, I don't really like covering Tesco's now. It was a favourite of the show and it's a very good business and we'll come on to the results. It is one I used to own and I sort of, owned it through thick and thin, really. I bought it shortly after the horse meat scandal, which was back in 2013. And then I think I only sold it last year. And that was really after the turnaround had gathered pace. And I thought, there are better opportunities fairly close to saturation point, which we will come to, and room for growth. So looked elsewhere. It's unfortunate that I think the market has really accepted that, and the share price has responded pretty positively after I'd sold it. So anyway, I'm a little bit bitter. But anyway, Tesco had their half-year results out with the group reporting half-year sales growing by 4% to £31.5 billion. And that's ignoring fuel sales and exchange rates. Growth had been led by increased volumes, with the group continuing to invest in keeping prices low and goods inflation eased. Volumes in its Finest range were up 14.9%. And retail underlying operating profit rose 10% to £1.6 billion. Cost cuts and productivity improvements more than offset increases in staff pay and efforts to keep prices down. Free cash flow fell from £1.4 billion to £1.3 billion, and net debt came in at £9.7 billion, which was 2.1% lower at the half-year mark. Full-year guidance has been upgraded as a result of better than expected volume growth. Underlying retail operating profit is now expected to be around £2.9 billion, up from what they said was at least 2.8 billion. An interim dividend of 4.25 per share has been announced, which is up 10.4%, and Tesco's is on track to complete a £1 billion share buyback programme by April 25, with £575 million completed in the first half. And shares were up around 1.5% after the results. In terms of valuation, Tesco's has a market cap of £24 billion and trades at 13 times forward earnings, compared with a 10-year average of 12.7, and it had a prospective dividend yield of 3.8%. I thought these results were very good. I think particularly when you saw some of the volume growth and volume growth in the finest range, it's continuing to deliver, not particularly expensive. Definitely, as far as I'm concerned, the best supermarket there is. And it's, got a decent dividend yield going for it. Downsides to it, and they're largely the reasons I sold, was that the supermarket had tried expansion overseas, in the States, Central Europe, Thailand, and it had largely been beaten back from those markets, so the tail between its legs. And I guess now you are just buying essentially the UK supermarket. You've got Booker in there, which I think is a positive for the group and does add to it. However, it kind of is at saturation point. You're not growing anywhere else. That has been tried and didn't work. So whilst it is very well run, it's generating decent profits. They're doing share buybacks and returning cash to shareholders and dividends. I think for my portfolio, I would be looking for more growth. And that's something that I don't think Tesco can deliver, albeit being a very good business. Sam, what are your thoughts on Tesco's?
Pretty similar. I'm putting you on the spot here, but I was in Slovakia last month and they actually had a Tesco there, which I didn't
Yeah,
expect.
yeah.
Do you know why they're still there?
I know they sold off the Thailand business and we got quite a chunky dividend from that. And obviously the US, they just left, and that was very much tail between the legs. They still do have some Central European stores. So I just anecdotally, I've seen a few stores when I've been in the Czech Republic. I don't know is the honest answer why that has been particularly retained. I don't ever remember it being a real standout performer there, but it seems to be a bit of a small part of the legacy from it, but it is a tiny amount when you look at it in terms of the proportion of revenues that come from Central Europe.
Yes, I think they're only really in, I think left, it might just be Czech Republic, Hungary, and Slovakia. So I think it's just a bit coincidental that we just happen to have seen them in two of the three countries where they still are.
Yeah.
But so in June 23, the CEO said it was an integral part of the group.
Mm.
So he was asked about it at the AGM, which is when he said he saw it as integral.
Mm.
And they don't distract them much from the core business, and they think the market's. But I mean, he's got to say something, hasn't he, in the AGM? If someone basically
He was.
asks that question, why they haven't got out of it.
I was going to say he was put on the spot there.
Yeah, I don't think he's really said anything about it. I guess
Yeah.
if it's not doing terribly, maybe no one's ever had a proper look at it. Whereas I think the other ones were doing quite badly, weren't they? Like Thailand and
Yeah.
the US.
Yeah, well,
Whereas
I
if these
don't know.
ones are okay.
Yeah. I don't think. I mean, the US was just a disaster, but yeah, Thailand. I don't think. I think it was a bit more mixed there.
Okay. Anyway, it's obviously not a big part of revenue anyway. But yeah, I just think with Tesco, I mean, it's had a slight revaluation since you sold it. But in terms of the figures, 4% is kind of what we've got. And there's no surprises in here. I think I know it's painful for you, but when you look at the share price, there's not, and then you look at the results, I don't feel like there's anything. It's a good business and it's doing well, but there's nothing in the results, I don't feel like, that justifies the performance pretty much since you sold it, actually.
Yeah.
But that being said, at a forward P of 13, it's not terrible, but that prospective yield now is only 3.8%. And I think we have seen it quite a bit higher in the past. And that's
Yeah.
not including those special dividends that you'd had recently as well.
Yeah.
So, and then when you compare that to what you could get in a bank, there's probably not going to be that much growth on it. I don't know. If you can get 4% in a bank account and there's no growth, would you pay 13 times earnings? Obviously, people are, but
Yeah.
yeah, I find the share price a bit surprising, actually. I genuinely think you've been a bit unlucky there because I don't feel like the business has bombed away since
Yeah.
you sold it.
Yeah.
It's just had a revaluation by the market.
Exactly, it has. And what did I'm just having a quick look. Yeah, I'd have to check the exact date that I
Oh,
sold it.
don't do it to yourself.
Don't do it. Okay,
I
fine,
do
fine,
find it
fine.
interesting as well that the finest volumes were at 14% for the finest range. Just in terms of what that says about the wider economy, that suggests people are feeling a bit better, doesn't it, really? And kind of over the cost of living crisis now. Because if that's up 15%, people are obviously feeling slightly more
Well,
affluent.
and that's it. And I think what's excellent from a Tesco shareholder point of view is that people are trading up within Tesco's. They're not. I mean, you don't know the figures, but they're not necessarily all say going to M&S or Waitrose. It's being spent within Tesco, so you've got people at kind of both ends of it. But anyway, I want. I've got this far, so I've got the price. I'm just
Oh,
going to do the cut. Going to see what the share price was. I know I was about flat when you took into account divvies and things. So
nothing good can come of this.
so I sold it at about £2.59, and it's currently £3.56.
Oh.
Okay, okay, okay.
Are you glad you looked?
I don't know, probably
Ah,
not, but I'm saving
bit
face.
ruthless. I mean, it's 10 years you waited as well for it to go
Oh,
back up to
yeah,
£3.50. Does it
yeah.
within a year of you selling? It's just
I know, but that always seems to be the way.
always feels like that.
Oh, it always feels like that. I mean, I say that I did. What had I sold that was at close to the top? Well, there's GoPro, that was one. Snapchat, that was another, and then Baidu as well. I mean, that's been well, much lower for a number of years since I sold. So there have been a few things, a few winners. Yeah, we won't talk about Boohoo. That's yeah.
No, I mean, in fairness, I sold Wix earlier this year to buy a new car, and Wix has
Oh, is
done
it
very.
bombed away?
I think it was up like
Oh,
it wasn't
actually, no, we
loads.
did, we did. Yeah,
It
we
was
went
like
over
20,
that.
25% last time I looked.
Yeah,
It's
yeah, yeah,
annoying as
yeah.
well because it had been. It's one that I would actually consider buying back. I did like the shares. I did like the company. I just had to sell some. Oh, it might have. No, it's not. Well, it's not gone up any further.
Yeah,
But
it's
yeah, you can. I mean, again, you look at the share price over the past year, and within about a month or two of me selling it, it's up 25-30%. But fine.
yeah. I mean, this is the game, isn't it? That you're in. It's
Well, that's it. It's easy to look back at those
yeah.
ones. But
It's
anyway, shall we move on
yeah.
to JD Sports?
Yeah, absolutely. So tell us, Sam, how's the top retailer doing?
So JD Sports, a business we've covered multiple times now, they have come out with their first half results, and first half organic revenue was up 6.4% to £5 billion. Europe, North America, and Asia Pacific all posted double-digit growth, while the UK posted a decline, reflecting a challenging and volatile market. Underlying pre-tax profits were up 3.4% to 405.6 million, ignoring currency impacts. Despite an increase in operating margin, profit growth was held back by rising finance charges. Free cash flow fell from 99 to 88.4 million. Net debt, including leases, rose from 1.1 to 2.8 billion, largely as a result of the Hibbett acquisition. And the Hibbett acquisition, by the way, was about $1 billion, I think. So full year guidance has been reiterated, and they're expecting underlying pre-tax profits of 955 to 1.035 billion. But this now includes a 25 million contribution from Hibbett, which was previously excluded. So that means there's actually a small downgrade of a couple of percent. An interim dividend of 33p a share was announced, up 10%, and the shares fell 3.8% following the announcement. Interestingly, the global sports apparel market is valued at $396 billion, but is expected to grow to $544 billion by 2028. And JD are currently Nike's largest partner globally. In terms of valuation, business trades at a forward P of 10.4, and that compares with a 10-year average of 16.4. The prospective dividend yield is 0.7%, and that compares to a 10-year average of 0.6. We've covered this a few times and been fairly critical of particularly the American expansion. And the issue I've had is I just don't know if the brands it's buying are diluting the quality, because is Shoe Palace or Hibbett's as high quality as JD Sports? Is it as cool as JD Sports is in the
Mm.
UK? I just don't know. But they're growing double digits everywhere, so you can't really knock that. I still have concerns, and I know Nike's not doing that well at the minute, so they're probably going to leave JD alone for a little while. But prior to Nike's recent wobble in the last year or two, they're really going for their direct to consumer, and so are Adidas. And that might have had a short-term wobble, but I don't think that's going to change. And people talk about JD being Nike's single largest partner as if it's a strength, and they're getting all these unique deals and stuff, and they're getting, exclusive releases on some products. I think although it probably is a strength right now, I think in the longer term that could be a weakness because Nike and Adidas don't want to be selling through JD. They want to be selling direct. That's where they want to be going because they're just going to have better margins. Long term, I have some concerns. That being said, I think it's a good business. I think they're doing everything they can. I think they're executing well. I think they're probably in the fortunate position that it does seem like we talked about it in the last interview that I did with Flying Finance. It's one of the later episodes. I think it's like episode 197, 198 or something like that. And he'd kind of made the point that it's not just Nike and Adidas now. There are quite a few new brands where it's, New Balance is just so much bigger than it was 5 years ago. Skechers, you're seeing those all the times. And in terms of cool trainers, it's actually, he was arguing that sort of maybe that puts JD in a stronger position in that if Nike wants to pull out of the stores, actually people might just go in and buy a Skechers instead. And it could actually be Nike that loses out. I don't know. I don't think it's obvious that that is the case, but I think there's a discussion to be had. I think the main thing JD Sports has going for it actually is that the forward PE is 10.4 because I think that's the cheapest since we started covering it. And I actually think, I know the revenue growth is only 6.4%, but that's mainly because of the declining share in the UK, which I think it's fair to say is pretty saturated. But Europe, North America, and Asia Pacific, all double-digit growth. I don't think you can really knock that. So I think for me, long term, there's still quite a lot of concerns. But at 10 times earnings, I can see why someone would be interested in it. And I do think it's a very well-run business. What about you, John?
Yeah, no, similar. I think for me, the direct consumer is a big issue, and it almost just takes away, well, it almost just destroys the investment case for it. That's what I would be most worried about. I think overall it looks like it's a well-run business, and it certainly is doing well so far. But I think that would be sort of an existential sort of problem for them, and clearly one that's not going away. So yeah, I would probably just steer clear of purely for that reason.
Right, should we move on to another business that you might be steering clear of?
Yeah, I mean, it's going to the travel sector. It's Tui. And in fact, it is sort of new because it was previously listed on the London Stock Exchange. It's actually delisted and it's just in Germany now. I don't think it's any great loss to the London Stock Exchange or the FTSE, quite honestly. But anyway, they had the Q4 trading statement out, and Chewy's Market and Airlines division saw bookings and average selling prices rise 6% and 3% respectively in the fourth quarter summer period. Bookings for the new year have also started strongly with a third of capacity already sold and ASP up across all markets, and that's helping offset their higher costs. Holiday experiences, so hotels and resorts, cruises, and amusements remain on track, with management expectations in all segments posting growth in the fourth quarter. However, due to planned renovations, hotel capacity is set to decline by 2% in the first half of the new year. Chewy also reiterated full-year guidance with underlying operating profits to grow by at least 25%, and full year 23 was 977 million euros for reference. And consensus amongst analysts is more optimistic, expecting growth of more than 30%. Medium-term guidance calls for underlying operating profits to grow between 7 and 10% annually. In terms of valuation, Chewy has a market cap of 3.55 billion euros and trades a forward price to book of 1.35, compared with a 10-year average of 3.66. I thought these results were actually pretty good. I think it's a very difficult sector to operate in. It's certainly one that is cyclical and intensely competitive. It's a sector I wouldn't invest in anyway. Chewy does seem to be doing, pretty well in it, despite all of the difficulties. And I think you saw debt balloon in the group back around COVID times. That has come down, and it's now only 2.1 billion euros. But it's one of those industries with all that competition, and ultimately the race to the bottom. You've seen a lot of travel agents go bust with all the online competition. It's a sector that I just wouldn't go near. So it's interesting to cover TUI on the show, but for me as an investment, it's one I just, yeah, as I say, barge pole sort of territory. Sam, what are your thoughts on TUI?
Pretty similar. Seems to be performing better, but it's just an uninvestable industry. So yeah, there's not really a huge amount to say. I mean, the only reason I don't mind covering it is because I think it gives a quite a good indication of how the economy more generally is doing.
Mm.
But, we cover it every 6 months or so, mainly for that reason, because there is nothing it could have in these results that I think would want me to get into kind of the travel industry. I suppose it's a bit better in that at least it's not just like a pure airline. So it does
Yeah,
have that going for it. It's probably the best of a bad bunch, but
yeah,
I just still wouldn't touch it because the problem is in the other industries it's in, are probably in long-term decline, aren't they? With, I do feel like more people are booking holidays themselves and stuff like that, and there's just much more
yeah,
competition. So I feel like every industry, and then they're in obviously cruises as well, and it's
yeah,
just, it seems they seem very unlucky with the industries that they're in terms of
yeah.
these decline.
I mean, I suppose it's that sort of some of the lessons from Peter Lynch in that sense that you know what you're doing yourself, and I suppose he's looking more for opportunities rather than spotting the losers. But when I don't know about you, but I'm booking my own holiday, it'll be looking sort of Sky Scanner, so you're comparing flights, generally going with the cheapest one for whatever the route is, and then you might be using a search engine, whether it's Trivago or equivalent, to try and find the cheapest hotel deal. And that's assuming that you are staying in a hotel as opposed to an Airbnb or, self-catered. And perhaps TUI comes up on there, but it is all very price sensitive. And it's usually booking the hotel or whatever, putting that holiday together through the lowest cost, lowest cost providers.
Yeah, and I mean, obviously, I've never booked through a provider like that at all myself. I know some people who have where it's just they just want to go away and not have to worry about it. And like, it sort of serves a purpose. But even the people I know that have done it, you go back 30, 40 years, they've probably been doing it for most holidays, whereas now it's kind of an occasional thing if someone just wants to, pay a bit extra just for the convenience. But
Yeah.
yeah, I think long term, I think it's got some serious issues. It's not really.
Yeah.
I mean, it's not when we're talking about price to book. It's not even like you're going to get the money back out of it in dividends or anything. So
No.
yeah,
I mean, I
yeah,
think it's interesting with travel agents. I think potentially, something like more like Trail Finders, which I think is a private company, where it's a little bit more specialist and where you might be creating more of a bespoke trip that would be more difficult to create yourself and, a lot more hassle. But I think the sort of places that Chewy operates in are the ones where it's incredibly easy, as we've all experienced with, just being online and being on the web, that you can book a flight, a hotel, if you want to, and then probably a transfer by like 3 Google searches, and that's kind of it.
yeah. So it's a tricky one.
Anyway,
So
we,
yeah,
we
so
we clearly aren't making the investment case for it. So shall we move on to a company that we do both like?
yes, so PepsiCo. Business that needs no introduction. They've obviously got the Pepsi brand and all the other associated drinks, but that does include Dr. Pepper, Lipton's, Mountain Dew, Tropicana, Starbucks for the ones that they do in like when you buy them in the supermarkets, like the cold ones or whatever else. Gatorade, not just the drinks as well. They've also got a lot of snacks. So they've got Cheetos, Captain Crunch, Doritos, Lay's, Walkers, Quaker. They've got 7 Up. I know that's a drink, but that's quite a big one. Snacker Jacks. And these are just the ones I'm picking out that I know everyone will know what they are. They've got absolutely loads. So really interesting. That's probably the main thing actually that differentiates it from Coke. Coke is more just drinks focused. So Pepsi have come out with their Q3 results and revenue grew by 1.3% on an organic basis, reaching $23.3 billion in the third quarter, ignoring currency impacts. Growth was driven entirely by higher prices as volumes of both food and drink fell. Quaker Oats continues to see the biggest decline in volumes due to product recalls after contamination concerns. Underlying operating profit rose at a faster pace of 6% to $4.2 billion as strong cost controls helped improve profitability. Free cash flow has worsened from 5.2 to 3.5 billion over the first 3 quarters, largely due to the timing of payments. Net debt rose from 34 billion to 37 billion over the same period. Full year organic revenue growth has been downgraded for the second time in as many quarters, with management now expecting low single-digit growth, and that's down from around 4%. Earnings per share guidance of at least $8.15 remains unchanged, and the shares fell 1.2% in pre-market trading. In terms of the valuation, the business trades at a forward PE of 19.6, and that compares to a 10-year average of 21.8. The prospective yield for the next 12 months is 3.3%, and that compares to a 10-year average of 3. I think these results were pretty poor, especially with the volumes dropping for food and drinks. 1.3% growth is not good. I think previously they had actually demonstrated a little bit of pricing power, so it seems that price increases may have caught up with them now. I think the results are poor. That being said, I think it's a great business with some great brands. I just think, yes, it's come down, but 20 times earnings is still quite expensive for a business growing 1% a year. And I think we don't know whether this is just a temporary wobble or maybe the start of a slightly longer trend that could last a year or two. If it's the start of a longer trend, I think you're probably going to get the chance to buy it at cheaper than 19.6 times earnings. And I think considering how poor these results are, I feel like there's still a premium for the fact that it's listed in America. I think if it was listed in the UK, even with brands of that quality, I think with those results, it would be trading slightly lower. So yeah, I think if you were interested in it, I'd probably still wait and see. Now, we could be sat here in 3-6 months and actually it's shot back up. But I just think for a business growing 1.3% a year, and as well, it's like, even if it does well, it's not going to grow more than 4 or 5% probably. So to pay 20 times earnings for a business where best case scenario it gets back to 4 or 5% growth, I still think you'd be overpaying. What do you think, John?
Yeah, I would tend to agree with you. I think it's a fantastic business. These results, a bit disappointing. I would like to own it, but at this price, I think it's still difficult to justify. So I think it'll be an interesting one to watch and just see how the share price reacts, particularly if there are, a couple more quarters that are a bit lackluster, and just see whether that valuation trends downwards.
Right then. So of the 6 businesses that we've covered this week, Greggs, AG Barr, Tesco, JD Sports, Tui and PepsiCo, which do you like the most and which do you like the least?
No, what was the valuation of AG Barr again?
About 18.
Probably go for AG Barr. I think long term, Pepsi, with the incredible brands that it has, I would back. But I think with how they're currently performing and valuation, I'd probably go with AG Barr. And bottom of the list, I'd go Chewy. JD Sports would be the next, but Chewy definitely the worst.
Without sounding boring, I would probably do the same. So yeah, AG Barr, it is a bit pricey, but I think it's probably also got the most growth potential. I think the one I would consider second would probably actually be Tesco. But you're buying it because it's a decent valuation, but it's probably not going to grow. Chewy's an easy last. It's just uninvestable. If I was to take Chewy out, it would be a bit tougher, actually. I think it might be Greggs, because I think with JD Sports, I know there's risks with it, but it is 10 times earnings is very cheap.
Yeah.
I do kind of feel like those risks are definitely priced in now. Whereas before, when it was at 15, 16 times earnings, I wasn't as sure. But I think at 10, actually, it's probably much more fairly priced.
No, fair enough. Okay. Well, thank you again for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.